all and welcome to BDO Christchurch's presentation of this Financial Fundamentals webinar. My name is Leslie Alexander. I'm an EA and the Events and Marketing Coordinator here at BDO Christchurch, and I'll be your moderator today. Before we begin, I want to note some of the ways to interact and move about during this webinar. Your computer or phone audio settings will be where you can adjust the volume and the device you're listening on. All attendees are in listen-only mode, which means you cannot share audio and video throughout the duration of the webinar. Please feel free to hit the speech bubble with the question mark in it at any time during the webinar to ask our presenters any questions about the webinar. You can tick the anonymous button if you wish. See the red box in the bottom left corner. We will attempt to get through as many questions as we can at the end of the webinar. If for any reason you need to leave the webinar, you can do so. The link that you used to join will still work if you wish to rejoin while the webinar is still live. If you have any issues with the software throughout, there is a Need Help link which may help, or else send us a question in the Q&A tab and we will endeavour to fix this issue for you. I want to also note that following the webinar, we will send out a recording to all registered attendees. So if you missed any of the webinar or would like to refer back to it in the future, you can. I am pleased to introduce you today to our two presenters, Kate Goodwin and Sam Rogatsky. This webinar should run for around 60 minutes, including Q&A time at the end. I will now pass you over to Kate to get started.
Thanks, Leslie, and thanks everyone for taking the time to listen into this webinar. Before I start, I thought I'd share with you our thought for the session, and that is that the budget is not just a collection of numbers, but an expression of our values and aspirations. And that really highlights the idea that numbers are included in your budgets and forecasts. Express your goals for the business over the next 12 months. And now we want to make sure you can understand, monitor and measure what you've set in those budgets and forecasts. This webinar is about giving you an understanding of the most common reports you'll be seeing on a weekly, monthly, quarterly and annual basis. So you're in control of your business performance. Here, I thought I would just take you through the agenda. So over the next 60 minutes, we'll be covering the importance of knowing your numbers. We'll give you an overview of the different reports you should be producing, the difference between profit and cash, the key drivers of business value, how to protect your assets, and how to adopt best practice. Then we will outline some potential next steps for you to take to make sure you truly understand your numbers. Please make sure you take plenty of notes today. We may cover some topics you are not familiar with, so if you have any questions, please send them throughout the webinar and we will answer these at the end. Knowing your numbers is vital, as it allows you to interpret your reports and know if you're on track to achieve the goals set out in your business plan. These are our top 6 reasons why you need to know your numbers. The first one is that they tell a story of your business, allowing you to understand the results of your business activity. Secondly, it allows you to identify the source of issues in your business, not just the signs of those issues. For example, a decline in gross profit is a sign of many causes, such as ineffective pricing, rework, poor purchasing, or wastage. Our third point is that knowing your numbers will enable you to spot an early warning sign of a potential issue. For example, if you monitor how many days it takes customers to pay, this will then allow you to quickly respond if that number of days starts to increase. Fourthly, areas of strength and weakness are highlighted. For example, your balance sheet indicates whether your business value is going up or down. Our fifth point is that understanding your numbers also means you have reliable financial information to base your decisions on. And finally, knowledge is power. The more you know about your business, the better your business can be. Today, we will review each of the key reports listed here to help you understand what you can learn from them. We'll work through an example to show key takeaways and things to look out for in your reports. In this webinar, we have made up a company called FoodsCo to use as an example. The first key report is the trading account, which is generally shown in the top portion of the profit and loss. Your trading account tracks your sales, variable costs, and gross profit to calculate the return you're achieving before deducting your fixed overhead costs. The gross profit percentage shown in the trading account indicates whether your margins are improving or deteriorating. You can track your results across different divisions or product lines by using multiple trading accounts. For example, if you have multiple regional locations, you can have a trading account for each location, which will then allow you to track how each is performing. Shown on this slide is an example of a trading account for our food manufacturing company, FoodsCo. As you can see, they had sales of just over 1 million and costs of sales of 318,000, giving them a gross surplus from trading of just under 700,000. Their direct costs were just over 450,000. So their gross surplus was 249,000, giving them a gross profit percentage of 24%. Now let's make some changes. Let's say this company implements strategies to increase their customer retention rate, resulting in a 10% increase in sales. They also work on with their accountant to review their inventory processes and reduce their cost of sales by 5%. They renegotiate their contract with their delivery provider, resulting in a 5% saving in their direct costs. As a result of these changes, their gross surplus has increased by 140,000, and their gross profit percentage has increased from 24% to 35%. Understanding your trading account allows you to identify areas where small improvements can have a big impact on the profitability of your business. The next report we'd like to take you through is the profit and loss statement. Your profit and loss, also known as an income statement, shows all your earnings and costs over the year and tracks the overall performance of your business. It matches your income and expenses for the period, with adjustments made for timing differences. For example, where sales have been made, but the money hasn't yet been received. It's important to remember that profit is not cash. The profit shown in your profit and loss statement includes non-cash expenses such as depreciation. You must ensure you have sufficient profit to cover cash costs, such as loan principal repayments, asset purchases, and drawings. Your profit and loss statement provides a framework to benchmark your results by using percentages or comparisons between years to compare your business performance to similar businesses. Businesses are generally valued using a multiplier of earnings, so your profit and loss statement is a fundamental driver of the value of your business. The higher the earnings, the higher the value of your business. This is an example of a profit and loss statement using our example foods company. We've taken the gross surplus from the trading account shown previously and listed all of the expenses, followed by the owner's remuneration to calculate the net surplus or loss. As you can see, the company is currently trading at a loss of over 113,000. Let's say the company undertakes a review of all their expenses with their accountant and identifies potential savings to be made to their insurances and rent. They can contact an insurance broker and their landlord and negotiate a 5% reduction in both expenses. They've saved nearly $600 in insurance expenses and just under $3,000 in rent expenses. You'll notice that accountancy fees have gone up. Remember in the previous example, the company had engaged their accountant for coaching and other services. Despite the increase in their accountancy fees, the overall net surplus has increased by $138,000 to $24,000 due to the savings made. The next key report is the balance sheet. Your balance sheet, also known as a statement of financial position, provides a snapshot of your business's financial position at a specific point in time. It measures the net worth of your business, that is, your assets less your liabilities. It also shows if a business is insolvent. If liabilities are greater than assets, then the business is insolvent and action is required to fix this. You can compare different periods to determine whether the business's net worth is increasing or decreasing between years, and can track the strength of the business. The stronger your balance sheet, the easier it will be for your business to survive in a downturn. It also provides a basis to calculate key ratios such as debtor days and inventory days. As you can see, Foods Company is currently insolvent as it has more liabilities than assets. Its working capital is also negative as its current assets of $183,000 are less than its current liabilities of $162,000. This means the company cannot pay its short-term debts from the limited cash, debtors and stock it has on hand. Urgent action is required to remedy this. The company needs an injection of funds of at least $305,000, which may be in the form of share capital or a shareholder loan. Assuming the company can resolve these urgent solvency issues, there are other areas for improvement too. Over the long term, the company could implement strategies to reduce their debtor and inventory days to increase their cash flow. To calculate your debtor days, divide debtors by sales, then multiply by 365. This tells you how long it takes customers to pay. Currently, this company's debtor days are 26. That means that on average, it takes customers 26 days to pay their bills. If they'd updated their terms of trade and requested payment within 7 days and managed to reduce this by 5 days to 21 days, they'd have an additional $14,000 available. To calculate inventory days, divide inventories by cost of sales, then multiply by 365. This tells you how long the business holds its inventory before selling it. In other words, it shows how long your cash is tied up in inventory. This company currently holds inventory for 74 days. If they reviewed and updated the inventory processes and reduced the amount of inventory they have on hand, they might be able to improve their inventory days by 9. This would result in a cash flow boost of nearly $8,000. So while this cash flow gain of nearly $22,000 doesn't fix the solvency issue and demonstrates how much cash could be saved with some help from their accountant. The next key report is the Statement of Changes in Equity. This report shows what happens to the company's profits. Profits can be paid out as dividends or kept in the company as retained earnings. It represents the net worth or value of the company and is a key indicator of the company's financial health. It shows whether a company is solvent. Remember, if the company has more liabilities than assets, it's insolvent, and funds need to be paid into the company. The company has accumulated losses for at least the last 3 years. This means that the company has no retained earnings and is currently insolvent. There's no money to pay out as dividends and no money to reinvest into the company to purchase new assets. The directors must take action now to increase the profitability of the company. The next key report, the shareholder current account, records all funds introduced into the business by shareholders or taken out of the business as drawings. It can help you monitor your personal expenditure from the business, and for businesses with more than one shareholder, it maintains a balance of the amount each shareholder has introduced or withdrawn from the business. It shows how much the business owes to each shareholder. If the account is overdrawn, it means the shareholder has taken out more than they've put in and now owes the company money. To put the account back into a positive balance, the shareholder can repay the loan, or the company can increase its profit to declare a dividend. If your shareholder current account is overdrawn, it's important to get advice from your accountant as soon as possible to discuss the best options for you and your business. The shareholder current account shows that at the start of the period, the company owed its sole shareholder, Mr. Doe, over $29,000. He has introduced $2,000 into the company during the year, but has taken over $9,000 out of the company in drawings and life insurance payments. This means at the end of the period, the company now owes Mr. Doe just under $22,000. The amount owed by the company to Mr. Doe can only be repaid if the company is solvent and has the cash available to make the repayment. Because our example company is insolvent, Mr. Doe will need to introduce more funds into the company so it's not trading while insolvent. To ensure the company will be able to repay the funds introduced, a profit improvement strategy should be implemented so that the company becomes profitable. For example, we demonstrated in the trading account and profit and loss statement examples of how small changes to processes could result in an improvement of $138,000. It's not sustainable for the shareholders to keep introducing money into the business if it's not profitable. I will now hand over to Sam, who will take you through our last key report and the other items on our agenda.
Thanks, Kate, and hello, everyone. So we're going through the fixed asset register now. So the fixed asset register, which is also known as the depreciation schedule, records a business's fixed assets, such as your vehicles, your land, buildings, plant, and equipment, and it shows the cost of these assets and how they're reduced over time. It provides a basis for keeping track of your business's assets and can be a really useful guide to determine when an asset needs to be replaced, so you can budget for them accordingly. It's also useful when selling a business, as it records the value of all of your fixed assets at a point in time. So the first column of the fixed asset register here lists the names of all the fixed assets, with the second column listing the price at which the asset was purchased. The next column shows the opening value of the asset at the start of the financial year. This is the cost less any depreciation that has been recorded from previous periods. Then we have purchases of new assets and disposals of old assets. Now, disposal doesn't necessarily mean you have to sell. It could just be that the asset has reached the end of its useful life for depreciation purposes and no longer holds any value on the fixed asset register. Next, we have the depreciation rate and the method used. This company uses DV, which is the diminishing value method, which depreciates an asset by a constant percentage of the opening value each year. The next column shows the depreciation for the period, followed by the closing accumulated depreciation. This is the amount that the asset has been depreciated by since it was purchased. And the final column is closing value, which shows the current value of the asset, and this will match up with what is recorded on the balance sheet. So after taking you through that sixth one, that is all of the 6 key reports that you should be producing and reviewing regularly. Each report tells a different story about your business, and they're all just as important as each other, and they all aid your decision making in a different way. If you've got any questions about any of those reports, flick them through now and we'll have a look at them by the end of this webinar. In the meantime though, we'll move on to understanding the difference, the really important difference between profit and cash. Okay, so it's common for business owners to get frustrated that their bank account doesn't seem to reflect their profits. It's essential that you understand the difference between your profit and your cash, and why a high profit doesn't necessarily result in more cash in your bank account. A profitable entity can go out of business because it's starved of cash. And on the flip side, a business running at a loss can still survive if it has access to funds from investors or financiers. In other words, cash flow is a reality for every business. Okay, so a little example here of the difference between profit and cash for a couple of items. So number one, we've got GST. This affects the cash balance in your business, but not your profit. Loan repayments, again, affects your cash balance, but not your profit. But the interest on those loan repayments affects both your profit and your cash. Asset purchases only affect your cash balance. And in the same vein, asset sales only affect your cash balance. On the flip side though, depreciation on those assets only affects your profit. So with this simple example here, you can see, even if your business has achieved a healthy profit, you may not have enough cash in the bank after paying your tax, making your loan repayments, and purchasing assets. So it might be helpful now to take you through the Business 101 cycle, which is another really useful way to demonstrate the difference between profit and cash. So first, we have owners who need to invest money in the business. Secondly, this money will then be used to purchase the assets or to hire the staff needed to run the business. The business may need funding at this stage to buy all the assets they need, so there could be a loan to finance some of these purchases. These assets generally used to generate a profit. You can increase your profit by growing your sales or your margins, but overhead expenses can drain your profit and result in a loss, especially if they're not managed well. What happens to that profit? It gets turned into cash. Drains on your cash include slow collection of debtors, high inventory days, loan repayments, tax payments, and payments to suppliers. A business can achieve cash gains by collecting those debtors faster, decreasing the time things are held up in inventory, and negotiating longer payment terms with your suppliers. After that, the owners take cash out of the business as drawings or personal loan repayments. The remaining cash after that can then be reinvested into the business, purchase more assets, generate more income, and the cycle continues. The aim is to go through the cycle as quickly as possible in your business to increase your return on investment. All right, so after cash flow, business value is the next most important measure of business success. Part of knowing your numbers is understanding and measuring the drivers of your business's value. These drivers might be your monthly recurring revenue, revenue growth, revenue per client, sales, or profit, as noted. These will be different for every single business, but we can work with you to identify the key drivers of your business's value. So what you want to do is enhance that value, right? To enhance the value of your business, you must first develop and implement a clear plan and document that, also documenting your organization structure and the roles within the levels of your business. Establishing cloud-based, real-time reporting allows you to make better decisions, and reviewing and documenting your systems and processes ensures your business is running as efficiently as possible. Reducing the reliance on the owners of the business helps enhance the value as well, as it will be easier for new owners to take over if the business were to be sold. And finally, identifying and managing the risks of the business mean these can be mitigated before they even become an issue. So as we've seen throughout the webinar, profitability, cash flow, and value of your business all affect you guys personally. If your business isn't profitable and doesn't have much cash available, you won't be able to fund your desired lifestyle. So there are a few other things you can do to help protect your assets, which we'll run through now. So number one, set up your business as a company to limit the personal liability. Number two, consider who should be a director of your company and which assets, if any, are held personally by the directors. Number three, ensure that you have security over any money you lend out to others. Number four, consider alternative ownership structures for high-value assets. So an example would be your business owns the commercial premises you're running out of. Consider moving the ownership of the premises to a separate limited liability company, so it's separate to the running of the business. Number five, review your terms of trade and your credit policies, ensuring that you only provide credit to customers who are likely to pay you. Number six, insurances. Review your insurances and make sure you have sufficient protection. It's good to do this quite often. For example, do you have business interruption insurance? Do you have indemnity insurance? And do you have enough cover to ensure the impact on your business of any adverse events is as minimal as possible? Number seven, ensure you undertake financial planning to manage your personal wealth outside of the business. And finally, plan for the future. Have you got an up-to-date will, powers of attorney, and a clear plan for transferring your assets to the next generation when the time comes? This list here is not exhaustive. They're just some of the ways that you can protect both your business and your personal assets. We can, again, help you to identify specific ways to protect those assets. So how does everything we've talked about today come together as best practice? Well, every business should use the three essential tools noted here: an annual business plan, or what we've been seeing in recent times, a business recovery plan. Two, an annual forecast. And then thirdly, ongoing reporting and accountability, which is really important. The reporting part of this ensures the numbers you want to achieve in your plan and forecast are being measured. And the accountability part, the accountability process is some form of coaching. Using an independent coach to hold you accountable definitely works. Knowing and understanding your numbers is just the beginning, and as it allows you to improve them and ultimately achieve your goals for the business. Now I'm going to hand back over to Kate to close out the webinar, and I'll see you again for the Q&A.
Thanks, Sam. So where to from here in these challenging times? Our aim is to help you take what you've learned today and implement some positive change in your business. Now it's time for you to decide what you're going to do. Take a few minutes after the webinar to write down 3 actions or projects you would like to add value to your business. What problems are you experiencing in your business? Identify these problems and use them as an opportunity to create a project to fix them. Doing nothing right now should not be an option. So now you know what you should be doing as best practice in your business. Here's how we can help you. If you don't currently have a business plan or business recovery plan, we can help you develop one. We can also create a cash flow forecast or update your cash flow forecast to reflect business changes. For those who need to be held accountable to complete your actions, we have a range of coaching options depending on the frequency which suits you. And finally, we can create your management reports each month, catching up with you to review them so we can discuss potential areas for improvement. The information in this educational webinar is general in nature and no substitute for specific tailored advice and support. By working with you one-on-one, we'll be able to identify the most important actions to take that will make the biggest impact on your results. So now if we just go through some of the questions we've had throughout the webinar.
So we've got one question, Kate, I'll get you to answer, is what's the best way to calculate WIP in a, WIP lockup in a professional firm? You want to go?
So that's a good question coming in. This would be sort of a similar calculation for what we took you through with our inventory days and our debtor days. So we'd look at your closing WIP and then divide that by your fees charged over the period, and then divide that by 365 days to get a WIP day, and then make some comparisons across periods for that.
Just to add to that, with the WIP, I think the best way to do it is rather than just doing it once a year, is to do it on a regular basis. Sometimes when you're clearing a lot of WIP at certain times in the year, it can skew the figures a little bit. So doing it on a regular basis, you'll be able to see the trend throughout the year. And when you're talking about closing WIP, often the discussion is between the cost to the firm between the cost of the firm or the charge out rate or what's been billed out. And normally we use the charge out rate. So it's the time and cost on the clock rather than what the cost is to the firm itself. But really good question. Thanks for that. We've got another one there.
Yeah, we've got another one here, and it's what's the difference between the annual accounts and accounts that can be produced throughout the year? So our annual accounts contain year-end adjustments for things like depreciation, tax, and where we split out interest or principal on our loans. And so the main difference between annual accounts is that they're historical in nature, whereas your regular monthly or quarterly management accounts give you up-to-date data.
And I'll just add in there as well, I guess for the most part, people that are listening to the webinar, your accounts at the end of the year are prepared so that the tax returns can be filed. So there's a lot of things to consider from a tax perspective, making sure that all of the ducks are in a row from that perspective. Whereas you're doing regular monthly accounts or quarterly accounts, normally tailored so that you can make management decisions in the business. So it's a slightly different lens, but they do sometimes look quite similar. And I think we've got a third and final question. If you've got any more, just put them through now, we can still handle them. The last one here we've got is, what is the difference between markup and margin? We've spoken about gross margin. Is that the same as the markup that you put on your prices? That's another really good question, and it does trip a lot of people up. The answer is sort of yes and no. Markup is, in dollar terms, the same as the margin, in that both are the difference between the cost price and what you sell for. But in terms of percentages and when you're looking at margin in the accounts, markup and margin aren't the same. So let's take an example. Say you buy some stock for $75 and you sell it for $100. Although the markup in dollar terms is $25, the markup percentage is 33%, which is the selling price divided by the cost price. The margin, as we mentioned, is 25%, being the $25 of profit divided into the sale price of $100. So hopefully that answers it.
Right.
Have we got any other questions? Have we?
No, I think that's all the questions we have. So
Cool.
we might close out the webinar. So thanks for everyone for taking the time to attend, and we really appreciate this because we know your time's valuable. At the end of the webinar, we're just going to email through a short survey to you, and we'd appreciate if you provided any feedback. We hope we've given you plenty of ideas to ponder and some clear next steps for you and your business. Thanks.